ARM holdings just moved nearly 10% in a single session, and if you dismissed it as noise, you missed something important about how the AI build-out is actually being monetized. This wasn't a meme stock. This was the market repricing a company that collects royalties on roughly 9% of all smartphones ever shipped and is now embedding itself into data center AI inference at scale. The real question isn't what happened today. The question is whether the underlying thesis just changed permanently, or whether this is the kind of violent move that hands retail investors a loss before they even understand the trade. Let's be precise about what happened. ARM Holdings reported results that came in ahead of consensus on both revenue and forward guidance. And the royalty revenue line, the number that actually matters for the long-term thesis, showed an acceleration. This is not a minor footnote. Royalty revenue is the compounding engine of ARM's business model. Every time a chip manufacturer ships a device using an ARM architecture, ARM gets paid. The rate they get paid has been increasing because the company has been successfully migrating customers to its newer, higher royalty architecture generations, specifically ARMv9, which commands roughly double the royalty rate of ARMv8. In 2026, the transition from V8 to V9 is hitting an inflection point in the data center. That's the new chapter. ARM's traditional stronghold was mobile. It still is. But the AI inference market, where models run on chips at the edge and in the cloud after training is complete, is now a serious second revenue vector. Major cloud providers are designing custom silicon on ARM architecture. That means higher royalty rates on higher value chips at much larger die sizes than a smartphone processor. The market wasn't just reacting to 1/4. It was adjusting a forward multiple based on evidence that the data center royalty ramp is real and happening faster than the bear case assumed. When a stock with a premium valuation delivers proof of concept on its most contested growth assumption, a 10% gap up is not irrational. It is the math of multiple expansion meeting accelerating fundamentals. That combination is exactly what institutional desks were positioned for, and what most retail participants missed entirely. Here is where intellectual honesty matters. ARM is not a cheap stock by any conventional metric. Even before today's move, it was trading at a forward price-to-earnings ratio that most value investors would walk away from without a second look. A near 10% single-day move on top of that requires scrutiny, not celebration. The way to think about valuation on a royalty business like ARM is not through a standard earnings multiple. You have to look at it through the lens of the total addressable royalty base and the rate trajectory. Every incremental chip that gets designed on ARM architecture is a semi-permanent revenue stream. These are not one-time contracts. The switching cost is enormous. Semiconductor design cycles run 3 to 5 years, and once an engineering team standardizes on an instruction set architecture, they do not casually walk away. This is a moat that looks different from a software subscription moat, but is arguably more durable. So the bear case is not really about competition displacing ARM tomorrow. The bear case is about valuation requiring near perfect execution. At the multiple ARM trades at, you are pricing in years of royalty acceleration with minimal slippage. If the data center ramp stalls, or if one major customer shifts design priorities, the stock reprices violently to the downside. Today's 9.7% gain built more risk into the position, not less. That is the counterintuitive reality of high multiple compounders. When they confirm their thesis, they also raise the price of being wrong going forward. Understanding that dynamic is what separates disciplined investors from momentum tourists. And just to be clear, none of this is financial advice. Every position requires your own due diligence on your own risk tolerance. Every time a high-profile stock gaps up 10% on volume, A predictable sequence plays out. Retail money floods in during the first hour, convinced they are buying momentum. Institutional desks that were already long use the liquidity to trim. The stock fades through the afternoon. By the close, latecomers are underwater, and the narrative flips from breakout to trap. This pattern is not universal, but it is common enough to treat as a default assumption until proven otherwise. The beginner mistake is conflating a good company with a good trade at any price. ARM Holdings may be one of the most strategically important semiconductor companies in the world. That assessment is defensible, but important company and buy it the morning after a 10% gap are completely separate statements. The market has already processed the news by the time you hear about it. You're not getting information advantage by watching a stock move on CNBC. You're watching the tail end of a repricing that started in pre-market, when institutions who held the stock overnight absorbed the catalyst. The correct framework for a day like today is not to react, it is to evaluate. Ask 3 questions. 1. Does this move confirm or contradict the thesis you already held? 2. Has the risk-reward ratio improved or deteriorated at the new price? 3. What is your time horizon, and does a single-day catalyst change it? For long-term investors who owned ARM before today, this is a day to reassess position sizing. For those without a position, it is a day to build a thesis, not to chase. The market will give you another entry. It always does. The question is whether you will be ready with a view when it arrives. We came in asking whether ARM's 9.7% move was rational or a trap. The answer is both, depending on when you showed up and why. The catalyst was real. The multiple expansion was mathematically defensible, and the risk profile just got harder for anyone buying today. That tension is the entire game. Next video, we are going inside the custom silicon race. Why every major cloud provider is now building their own ARM-based chips, and what that means for NVIDIA's moat. Subscribe so you don't miss it.